Hi and welcome to Swissquote's Daily Market Talk. It's Monday, 13th of July. Earnings season begins this week against a much tougher macroeconomic backdrop than investors had anticipated just a few weeks ago as Middle East tensions flare up again, pushing oil prices and global yields higher. So this week, attention turns to major US banks, ASML and TSMC earnings, where strong results may not be enough if expectations remain too high and geopolitical headlines are too hectic. So we will talk about that and more. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So last week ended with SK Hynix making history with a record debut in US trading for a foreign company. The stock rallied 13% on Friday as investors rushed to buy one of the hottest stocks of the moment in a US exchange, mainly because even after past year's more than 1700% rally, SK Hynix remains cheaper than some US counterparts. Its PE ratio today stands near 18 only versus Micron, for example, that currently has a PE ratio of around 22. Unfortunately, though, SK Hynix is down by more than 13% in South Korea today. From a technical perspective, it is now getting ready to test a critical Fibonacci support, which is the major 38.2% Fibonacci retracement on April 2025 to June 2026 rally that should distinguish between the continuation of the actual positive trend and a medium-term bearish consolidation, which would obviously call for a deeper downside correction in the coming months. Now, the reason why this stock, along with other memory chip maker stocks, has gone parabolic is because the AI demand somehow brought along the idea among investors that this sector that has always been marked by boom and bust cycles would stay in the boom cycle forever. And SK Hynix, because we are talking about this company today, is planning to double its capacity within the next 5 years to catch up with the rising demand for AI and AI infrastructure and all data centers that are being built today. The company's CEO said in a Bloomberg interview that they'd better multiply capacity by 4 or 5 to meet the increasing demand, but he also says that he doesn't know. He just doesn't know what will happen in the coming years. We could eventually see a technology progress, we could see more efficient AI models that would demand less memory needs, or simply slow down AI infrastructure investment that could suddenly flip the table and bring this market into the oversupply again. And that's the biggest challenge today, because it takes time and investment, obviously, to build these fabs that build these chips. And it's very, very difficult to meet the supply and demand in this industry because of this delay. Because demand is here today, but the supply will arrive when these new fabs will be up and running. So only time will tell how and when the two will meet and what will happen when they meet. But what we could tell today is that the volatility in the memory chip stock prices is too high to call the price action sustainable. The prices must come down, if nothing, due to the parabolic rise that we saw over the past months. Now, of course, the stock market volatility is a boon for banks' trading desks, and this is exactly what we will discover in a few days when the US big banks will start releasing their second quarter earnings. They're expected to print strong results on the back of this high stock market volatility, but also SpaceX IPO, for example, and the higher for longer interest rates. It's quite a sure thing that the consumer health is worrying right now, even more as the tensions in the Middle East are re-escalating again, pushing oil and energy prices higher. But the trading and net interest income revenue are expected to amply make up for the weaker consumer health. Besides the banks, ASML and TSMC will also announce their earnings this week and will probably print strong results given the AI spending and the demand for chips. But the question is not whether their earnings will be strong. There will be. The question is how the markets will react. Because remember last week, Samsung lost almost 10% after printing a 1900% profit growth last quarter and has kept falling since then. Therefore, the market's reaction to the technology earnings will be more important than the figures themselves. And because the technology stocks are priced to perfection, there are some inconvenient truths that investors will be considering that actually come and blur the picture a little bit. Among them, the spending is high, especially among the big technology companies, and the spending is now eating into the big technology's free cash flow. And second, the so-called hyperscalers are taking more debt on their shoulders to finance the AI spending. Third, investors are questioning the size of the AI capex and the return on investment. Four, at a time, borrowing costs are also rising due to geopolitical tensions. And note that because big technology is taking on more debt and they have more leveraged balance sheets today, they are also more sensitive to the borrowing costs that they have been back in 2023 when the Fed was tightening its policy. But this being said, the S&P 500's technology sector is still expected to print an estimated year-over-year earnings growth rate of 63.3% according to FactSet. That's up from 62% printed last week and significantly up from 48.6% since the end of March. While the S&P 500 is expected to print a 23.6% earnings growth in the second quarter of this year, also up compared to last week's 22% estimate. To say the expectations are high, they are quite high. And high expectations are harder to beat, obviously. Yeah, looking at the big technology only, the second quarter was actually marked by a pullback in valuations, quite a significant pullback in some places, because if you look at Google, for example, the stock price retreated more than 16% since its May peak and is down by around 10% today compared to its all-time high level. Then Nvidia lost up to 20% during the same period and is also down by around 10% today compared to its May all-time high level, while Microsoft was one of the most battered big technology stocks and lost more than a third of its value since last October and is down by around 30% compared to its all-time high levels today. This means that the big technology valuations today have come down significantly, meaningfully to allow a rebound in these companies' stock prices if earnings are strong enough. Then remains the sticky issue on the macroeconomic front, obviously, and that's the rising borrowing costs. The weekend wasn't calm in the Middle East. The US continued its attacks on Iran, while the latter attacked Gulf countries in retaliation. The US says today that the Strait of Hormuz is open to traffic, whereas Iran says it is not. This renewed uncertainty is pushing oil prices higher again this Monday morning. US crude is up by more than 4% this morning at the time I'm talking here. The higher oil prices in return fuel global inflation expectations, pushing global yields higher. In this context, the US 2-year yield that best captures the Federal Reserve expectations jumped to the highest level since February 2025, while the Japanese 10-year yield recovers last Friday's slump after Katayama called, remember, the country's pension funds to invest in domestic assets. The horror movie for global asset managers. But anyway, the higher yields is pressuring risk appetite this morning. Kospi is down by more than 7%, while Nikkei retreats by more than 3% in Tokyo today. The European and US futures are also in the negative, pointing at a bearish start to the week. Now we are heading into a week full of earnings, but also some important macroeconomic data and events. So besides bank and technology earnings, investors this week will be glued to their screens to see and obviously to interpret the latest US CPI figures as they watch oil prices come under a positive pressure again since a week now due to the Middle East tensions that flare up. And while the Middle East resolution sails farther away, Kevin Walsh, on the other hand, will be delivering his first annual testimony before the US Congress, but the man will unlikely to say anything different or more insightful than he did before. He wants to fight inflation and he does not want to make any assumptions or any predictions or any forecasts regarding the future when the future is so uncertain today due to the factors that he does not control or he cannot control with his monetary policy. As a result, we keep watching the Middle East, the impact on global economy and the macroeconomic data. The US dollar will likely follow oil prices higher in the coming days. Bond and stocks will likely move lower together, while gold will likely test the $4,000 per ounce support again, with however little conviction from investors that it's a good time to get in as yields go up. So, in my opinion, defensive stocks will likely amass inflows this week. So this is all for today. I'm İpek Özkardeskaya, and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.